Very good evening, delegates. Welcome to today's CPE meeting. We have with us CA Premlata Daga Sabu, who will take us through valuation of unquoted equity shares under income tax. I'm happy to introduce Madam. Premlata is a chartered accountant by profession and an educator by passion. She qualified as a chartered accountant in the year 2012 at a young age of 22. In her first attempt itself, it seems. With her interest in company law, she went on doing company secretary course. She even holds a diploma in information systems audit, a post-qualification course on information system by the Institute of Chartered Accountants of India. She is a partner in a leading LLP firm and a registered valuer for securities and asset class with IBBI. She started her career as an educator at a young age of 23 with the National Academy of Direct Taxes. She is one of the youngest visiting faculty at NADT and so far has taught financial accounting to 8 batches of IFRS officers. She has conducted 500 plus sessions on financial investigation through Tally at NADT. A big round of applause for that. And even direct tax regional training institutions at Bhopal, Chandigarh, Bengaluru, Kolkata, and Ahmedabad. Premlata has a rich industrial experience also. She has worked with reputed CA firms and corporate entities. She has even served as one of the youngest independent director on board of a listed company for 2 years. Her other achievements are nominated member of Direct Taxes Committee of WIRC. She was the nominated member of CPE Committee of WIRC, youngest contributor to the book Techniques of Investigations published by the Central Board of Direct Taxes, New Delhi. Awarded with a Women of Substance Award in the year 2018-19 by CFest and even by Times of India, and very interestingly, finalist of Cerebral Beauty Pageant 2020. With this brief, I present before you delegates CA Premlata Daga Sabu, who will take us through valuation of unquoted equity shares under income tax. Over to you, madam.
Thank you so much, sir. And thanks a lot to entire SIRC for giving me this opportunity again. Without taking any time, sir, I'll just share the screen and we can directly start on to the presentation part.
Visible, madam. You can continue.
Screen is visible. Okay, thank you, sir. Yeah. Okay, so we are going to talk on this topic again, which is valuation of unquoted equity shares. This is one of the most important topic because in today's time, almost every chartered accountant is dealing with some or the other private limited companies. And there are other methods also, but fortunately, Income Tax Department has reduced the method like to be followed for the valuation for the sake of Income Tax Act to the one defined in the provisions related to the same. So first we'll have a quick round from the sections that we are going to deal with. Basically, there had been 4 sections: 5627, 5627A, 5627B, and 562710. It's very important to know what section relates to what. I mean, which section is related to which part of the transaction. Firstly, section 5627 and 27A were made applicable from the year 2009 and 10 respectively, but since 1st April 2017, the same has been merged with 562710. This section was introduced in the year 2009. 5627 basically was applicable to individuals and HUF. So if you have any case which is like, even if it is scrutiny or income tax cases which is before 2017, so the relevant section will be 27 and 27A. So this section 27 basically is applicable to individual and HUF. It is applicable on the transfer of money, immovable property, or property other than immovable property. It was effective from 1st of October 2009 and 31st March 2017 was the last date for this section. After this, it got merged with 562710. Again, 5627A was a section which was introduced on 1st June 2010 when the firm or company, which is closely held company, dealt with any asset which is shares of a closely held company, then this section was applicable. Again, this section was merged with section 56.2.10. So 56.2.10 basically is a very, very broad section, which not only covers the section 56.2.7 and 7A, but it also covers all the loopholes which were there in these two sections. So now the two relevant sections from 1st April 2017 onwards are section 56.2.7B. It is applicable when a company issues the share. I'll try my level best that by the end of this session, you should have a complete clarity on which section is applicable when and what is the major difference between the two. So section 56.2.7B is applicable when a closely held company issues the shares. I repeat, 56.2.7B is applicable at the time when company issues the shares. And 56.2.10 is applicable when already issued shares are transferred from one person to the prospective buyer. So these are the two sections that we are going to study today. We have different rules for valuation under these two sections that we will see in the later part of this presentation. So this was made applicable from 1st of April 2013. It is still there as it is. And this section was made applicable from 1st April 2017 and presently it is continuing. So this is the brief background of the relevant sections that we are going to deal today. First, we'll take section 56.2.7B. I repeat again, this section is applicable when the company issues the shares. So when a company is issuing the shares, then the Income Tax Act says, where a company not being a company in which public are substantially interested, means they're talking about closely held companies, receives in any previous year from any person. Just a second. From any person being a resident. So what is important here is that this section is applicable when the shares are received from a resident. Any consideration for issue of shares that exceeds the face value of such shares, the aggregate consideration received for such shares as exceeds the fair market value shall be deemed to be the income of that company. So this section is applicable when the company issues the shares, and if the issue price is more than the fair market value, then the difference between the issue price and the fair market value will be taxed in the hands of the company under section 56.2.7B, which is under the head other sources. So this is about this section. Now this is a small example that if the face value of the share is 10, issue price is 50 and fair value is 30. Now when we talk about fair value here, basically this fair value is as per the valuation rules given by the Act. It's not a fair value by any other sources. Fair value under this provision has to be only considered for the purpose of taxation. For Companies Act, you may go for anything, but for the purpose of income tax, it has to be mandatorily as per the rules defined. In this case, the company would be taxed on 20 rupees under the head other sources. Now there are certain exceptions, provided that this clause shall not apply where the consideration for issue of shares is received by a venture capital undertaking from a venture capital company or a venture capital fund, by a company from a class or classes of person as may be notified by the central government on this behalf. There's an explanation. For the purpose of this clause, the fair market value of the shares shall be higher of the two, as may be determined in accordance with the method prescribed under Rule 11 UA. And second, as usual, is as may be sustained by the company to the satisfaction of assessing officer. So basically the second point is a gray area and it's quite subjective how you satisfy an assessing officer. What we are going to talk about in this session is how to calculate the same under Rule 11 UA. Second point is subjective. It is case to case basis and officer to officer basis. So nobody can talk on the second point, but on the first point, we will be definitely looking forward at this rule. So this is the brief background of the applicability of section 56 to 7B. Now, few important questions. When we read the act, basically we read it, but when it comes in the form of a question, that time actually we understand what are the hidden lines between the same. So let's have few good questions here. Is this section applicable when the amount is received from a non-resident? So if a company is issuing shares and the investor is not a resident of a country, then in that case, this particular section will not apply. In that case, there are RBI rules, FEMA rules that has to be complied, not the income tax rules. So if you have any situation where there's a non-resident investing into any Indian company, Indian closely held company, then in that case, don't go through Rule 11 UA. It is not applicable to a non-resident investor. Is this section applicable to issue of preference shares? Now, I would like to know from the audience, you can just answer in the chat box. Will this section apply if the company is issuing preference shares? Anybody can put an answer in the chat box.
Yes, ma'am. Chat box they responded yes, it applies 3 to 4 people and no some. I need to make you organizer so that you can visit that in all question box actually. I'll make you organizer in 1 minute.
Okay.
Or else we'll have the option of attendees to unmute themselves also. Okay, now they can unmute, and also I made you organizer so you can see there is an option called questions panel which can be expanded.
Okay. Okay, I can see this.
Yeah, that right next to into mark there is option to undock. Actually, if you click it, will expand it in a separate window. Actually.
How to expand it to separate window?
Yeah, there is option right next to into mark. There is option which you use to undock.
Got it.
There I can see the response. Yeah.
I hope that's not visible on the screen. Is it visible on the screen?
In the PPT, it is only to you, not for the audience.
Okay.
Only
okay.
we can see PPT, ma'am. We can see you can. We won't be seeing that.
Okay, okay. Okay, so we have a mixed opinion here that whether this provision will apply to preference shares or only to equity shares. The answer to this question is they are saying that it is applicable to all the shares. Just a second, I guess my PPT is on hold. Yeah, yes, as the word used in this section is share, it includes all the types of shares. That means equity shares as well as preference shares. But there are different rules for both. So now what we are going to study is, firstly, we are going to study the valuation for the shares which are issued by the company, and it includes both the types, equity as well as preference. So the rule is applicable to both, but they have different valuation rules. So let's move ahead here. What are the exceptions to this section? We have already seen that there are 2 exceptions. One, when it is from a venture capital fund to a venture capital undertaking, etc. And second, by a company from a class or classes of person as may be notified by the central government. Now, obviously, when these 2 exceptions are there, we need to even understand what do we mean by venture capital undertaking and a venture capital company. This is not as per the general understanding. This has been defined in the Act again. Venture capital company, venture capital fund, and venture capital undertaking have the same meaning as given or respectively assigned to them in explanation to clause 23 FB of section 10. So basically you can visit section 10 23 FB clause. There you can find the definitions for these 3 terms, and if your company is fitting into these 3, then only they will get an exemption from 56 to 7B, otherwise no. Again, in the exception class, we had even a notification. So obviously we need to know, is there any notification presently from the government which provides any exemption? There is one notification which was in the year 2018, to be precise, on 24th of May 2018, and this says that all the eligible startups for the purpose of section 80 IAC will also be an exemption for this particular section. I repeat, the eligible startup for the purpose of reduction under section 80 IAC, the same startups will basically be exempted from the applicability of section 5627B. Which are the prescribed methods for determination of fair market value of shares? So basically this rule has determined two different methods. One is net asset value method and the second is discounted cash flow method. So here you need to remember that when the company is basically issuing the shares, at that time two methods are allowed. One is the net asset value method and the second is discounted cash flow method. And when the company's existing shares are transferred, that time they have defined only one method, and that is the net asset value method. So presently, again, when a company issuing the shares, they can do the valuation using the net asset value method and DCF method, as the case may be. Now, for the purpose of calculating the net asset value method, they have given a formula. And that formula is defined under Rule 11UA2. Rule 11UA2 basically has given this simple formula: asset minus liability multiplied by PV divided by PE. Again, for the purpose of valuation of shares under Rule 11UA2, the assets are not required to be revalued. I repeat this again. If the company is issuing the shares, then the assets are to be taken at the book value and there is no requirement of revaluation. This is the confusion at this stage. When the company issues the shares, the assets are compulsorily required to be taken at book value. You cannot revalue the assets. And if you revalue the assets and then take the fair value for the purpose of valuation under net asset value method, then in that case, it will come with a tax implication as the premium would be high. So beware that when the company is issuing the shares, don't revalue your assets. Take your assets at the book value itself. Now this formula says that A is asset. They have clarified it is the book value of the assets in the balance sheet as reduced by any amount of tax paid as deduction or collection at source or advance tax payment as reduced by the amount of tax claimed as refund under the Income Tax Act and any amount shown in the balance sheet as including asset as an asset including the unamortized amount of deferred expenditure which does not represent the value of any asset. Basically what they are saying is, on the asset side, if you have TDS, TCS and advance tax which relates to your current financial years, then from the total assets you are required to reduce these three. But if you have any income tax refund receivable of any of the previous years, then that refund is not to be deducted. That is to be considered as an asset. And of course, any asset like unamortized expenditure, that is to be excluded. That means you should not consider unamortized amount as an asset in calculating while calculating the total value of assets. Now a simple question. If you have deferred tax asset, then what should be the treatment of deferred tax asset? On the asset side of your balance sheet, if you have deferred tax asset, then will you include it in your total assets or will you exclude it from your total assets? Any answers? Deferred tax asset and deferred tax liability, what shall be the treatment for it? That means if my total assets are 100 and I have 20 rupees as deferred tax asset, then for the purpose of this formula, we should take assets as 80 or we should take it as 100. Okay, so we have a mixed opinion here. In my personal opinion, deferred tax assets should not be included. That means we should take total assets at 80 because we cannot go end up selling that deferred tax asset and it cannot generate any economic value to me. It is an adjustment of timing difference and may take any number of years to be reversed. So this is basically subjective matter. There's no clarity on it. But if you have a significant amount of deferred tax asset in your financial statement, then you need to take it seriously at the time of making this calculation. From the liability sides of your balance sheet, you will include all the book value of liabilities, excluding paid up value of equity share capital, amounts set apart for undeclared dividend, reserves and surplus, provision for taxes, and provisions for unascertained liabilities and contingent liabilities. So from the liability side, we'll take all the outside liabilities, excluding equity, reserves, provision for taxes, and unascertained liabilities. Basically, if you see from the liability side, they are excluding provision for taxes, and from the asset side, they are excluding TDS, TCS, and advance tax. So whatever relates to taxes, they have excluded for the purpose of calculating this net worth. Now, this last thing in this formula, this is asset minus liability multiplied by PV divided by PE. Now, what is PV and PE? PV stands for paid up value of such equity shares, and PE stands for total amount of paid up equity share as shown in the balance sheet. In the last session, I have come across many queries with PV and PV. So basically here what they are doing is, instead of dividing this net worth with the number of equity shares, they are dividing it with the total paid up of capital. With this, what we get is per value rupee of equity. So for example, if my asset minus liability is 1000 and my total paid up equity is 100, then my per rupee paid up equity value is now 10 rupees. Now, why this formula is so designed? Because in a company, there can be different class of equity shares. A same company can have equity shares having face value 10. They may have equity shares having face value 5. So in this case, instead of dividing it with my number of shares, they divide it with the total value and then they multiply it with the paid up value of such equity shares. So if your shares is for 10 rupees, you will multiply it by 10. If your share is for 5 rupees, you will multiply it by 5 and you will get the fair market value per equity share under net asset value method. This is the logic of PV and PE. I hope everything is clear so far. Anybody, any doubt up to this stage? Yes, we'll come to this question that, okay, I'll just take it on an Excel sheet. Just a second. Is the Excel sheet visible? Okay, so now we'll first take a small example. For example, my total assets excluding advance tax, TDS, etc. is 200 and my total outside liabilities excluding income tax provisions and unascertained liabilities is 120. If I reduce this, I get 80. 80 is basically what? It is the asset minus liability. In short, this is the net worth of the company. So now, some mic is on. Can we just have it muted? Please check your mic. I guess somebody's mic is on. Can we just mute it? Okay, so we have now share capital. Please mute the mic. Sir, can you hear me? Your mic is on, sir. It's sir, your mic is creating a difference here. Can we unmute it? Mute it, sorry, the mic. Yeah, okay, thank you so much. So we are taking a small example here. We have asset minus liability as 80. Now, if this company is having, say, 10 shares of 10 rupees each, that means total 100 rupees shares. And if they are having 5 shares of rupees 5 each, that means 25. So now their total paid up capital is 125. This 80 rupees, we will divide it by 125. The total number of shares that we have is 10 shares and 5 shares. So I cannot divide this 125 with, I cannot divide this 80 with 15 because this is not equivalent shares. One is with face value 10 and one is with face value 5. Instead, I divide this 80 rupees with my total paid up value of total equity share capital. Now I get 0.64. When I multiply this 0.64 with 10 rupees, I get the fair value of share with face value 10. And if I multiply this 0.64 with 5 rupees, so I get 3.2, which is the fair value of the shares with face value 5. So this is basically the logic of PE and PV. Okay, so the questions which are relevant on this particular screen, we will take it simultaneously so that we don't miss the link. And other questions we may discuss in at the later stage or maybe at the end. So right now we could understand, I guess, the logic of PV and PE. Now moving ahead, who is authorized to issue the valuation report under DCF method for the purpose of section 56(2)(7)(b)? This basically earlier chartered accountant reports were allowed. If the company is following the DCF method, then up to 24th May 2018, a chartered accountant as well as a merchant banker were allowed to issue the report under DCF method. But later, after this notification dated 24th May 2018, only the merchant bankers are now authorized to issue the valuation report under DCF method for this particular section. Now, a CA certificate is irrelevant for the purpose of DCF method. Now, few important case laws here. Whether the AO can disregard the method adopted by the assessee and can carry on the valuation of shares using a different method. So basically, I'm not talking about that if a company has used the DCF method for valuation, can AO disregard DCF and do the valuation with NAV? So this is a case of Innovative Payment Solutions Private Limited. The Bangalore Tribunal addressed the issue on the application of DCF methodology and the powers of the AO to inquire into it. In the said case, the assessee could not conclusively establish that the projections used for the DCF method or valuation were prepared scientifically. It's not that once the DCF is given, you I have to accept it. Obviously, you have to explain the logics of using the DCF. The tribunal referred to the technical guide on share valuation by a research committee of ICAI, wherein it was stated that the DCF value is good. The DCF value is good as the assumptions used in developing the projections. If your assumptions are not good, your DCF value is certainly not good. So what assumptions you are taking for developing your projections, and these projections should consider various factors affecting the business. The tribunal held that if the assessee has opted for DCF, the AO cannot disregard and adopt another method. But however, the AO is well within his rights to examine the methodology adopted by the assessee and the underlying assumptions, and if he is not satisfied, he can challenge the same and suggest necessary modification. That means if the company has used DCF method, the AO cannot say that DCF is not scientific and he can straight away reject the file. He has to undergo, or he has to study the assumptions and the calculations and the logics given. And if he's not satisfied, he can first mention where the dissatisfaction is, and he can make some necessary changes. Just to give an example, like if the discounting factor used by the company is 15%, but the AO feel that 15% is too high, the discounting factor should be 12%, then he can ask for this modification. But of course, he has to also give reason that why the DCF should be at 12% and not the 15%. So a small change in the percentage can have a big impact on your valuation. Every part of the projections are to be considered scientifically and must have a backing and some logics for the purpose of valuation. Decision of Delhi Tribunal in case of Agro Portfolio Limited. There's one more case here. It was held that since there was no possibility of verifying the correctness of the data supplied by the assessee to the merchant banker, the correctness of the result of DCF method could not be verified. Hence, the AO had no option but to reject the DCF method and to go by the NAV method to determine the fair market value. So, if it is not at all possible to verify the data, there is no possibility of any suggestions and modifications. In that case, he has to just reject it and move ahead with the second option, that is NAV method. It's going to come with a huge difference because NAV, that too at book value, when compared with DCF, will have a big difference in the valuation of shares. Now coming to this topic, that if the company is issuing preference shares, then this rule will not apply, because I'll just take you back here. It says that Rule 11 UA2 is applicable when the company is issuing equity shares. So when the company is basically issuing the preference shares, then what will apply? Rule 11 UA2, which is specifically applicable for the valuation of shares for the purpose of section 5627B, covers only unquoted equity shares within its ambit, and there is no reference to the preference shares. Thus, the only method for determining the fair market value of preference shares is Rule 11 UA1, then subclause C and SCABI subpart C, which is reproduced here. The fair market value of unquoted shares and securities other than equity shares in a company which are not listed in any recognized stock exchange shall be estimated to be the price it would fetch if sold in the open market on the valuation date, and the assessee may obtain a report from a merchant banker or an accountant in respect of such valuation. Now, this is such a vague rule. What they're saying is, firstly, it's a closely held company. Secondly, it's a preference shares of an unquoted company. then the valuation is based on the price it will fetch in the open market. Firstly, a unlisted and a closely held company's preference shares will why have any market outside, that too on the valuation date. So practically this is having no logic. There is no market, there is no marketplace or no market valuation for this. So in this case, basically, if you are issuing a preference shares, then what is required is a report from a merchant banker or a chartered accountant. Here they have mentioned merchant banker or an accountant in respect of which such valuation. So basically for preference shares, you can consider that there is no rule because there is no market, and obviously you won't get any market valuation for it. It is dependent on the certificate issued by a merchant banker or a chartered accountant. But for equity shares, they have defined the method. They have defined who is allowed to issue the certificate. One common question that comes at this point is, if the company is following the net asset value method, in that case, a CA can also give the certificate. But if the company is following the DCF method, then a CA cannot give the certificate. Basically, a chartered accountant cannot sign the projections. So DCF method is based on projections, hence we don't sign those reports. Projections come from the company. We just do the calculation part. If you are giving a certificate for any company, which is a closely held company issuing a preference shares, then in that case, you should be very particular that you should not sign the DCF calculations. DCF will be given by management. You can verify it, but you cannot comment on the correctness of that DCF. You can just apply the formula, make the mechanical calculation and arrive at a value, but never sign the projections part. So this was about the preference shares. Now is a very important and interesting case law. In case of 2M Power Health Management Services Private Limited, the assessee allotted compulsorily convertible preference shares at a premium, and the holder of these preference shares had the right to attend the general meeting of the company and vote on resolutions directly affecting their interest. That means they can vote on the preference shares meeting only, shareholders meeting only. The tribunal held that with regard to the facts of the case, the nature of the issued share is actually that of an equity and not a preference shares, as they are compulsorily convertible. It is important to decide based on the evidence if the share premium received is for equity shares to be issued later or for preference shares issued now. If the premium received is mainly for conversion of preference shares into equity, Rule 11 UA may not be applicable. From the above judgment, one can infer that it is very important to identify the basic nature of the securities being issued and the rights attached to it to determine the valuation methodology under Rule 11 UA. Basically, the companies who wants, there's always some gray area in the act. It has defined the rules for equity shares. They have not defined the rules for preference shares. If the company today is issuing compulsorily convertible preference shares at a premium, there is no method of valuation defined. So this is subjective. In that case, if these shares get converted into equity shares, will Rule 11 UA apply? I repeat again, if a company has issued some convertible preference shares and later it gets converted into equity, then will the valuation of that conversion be done under Rule 11 UA? Can it be taxed at that time? So that question tab is not visible again. Okay, so it's there, sorry, missed it. Okay, the question is, I repeat the question, the company has issued the preference shares today. after 3 years, if they convert those preference shares into equity shares, can the valuation be done under this rule and it be taxed under section 5627B? Yes or no? Okay, so we are getting a mixed opinion here again. This is basically a surpass for this rule. If, okay, we have got one answer that convertible preference shares should follow rule of equity. Okay. So basically, a convertible preference shares today is not equity. For the purpose of even our balance sheet, we keep equity and even their rights. If the company gets into liquidation today, then basically they will be always having a preference over equity. I repeat, if a company has issued a convertible preference shares, then those shares are not equivalent to equity today. It will be equivalent to equity after conversion. Today, they are having a preference over equity. But if a company is converting those preference into equity, it cannot be taxed. Reason being, this transfer is not regarded as transfer. Under the sections, the capital gains, if a preference share is converted into equity shares, the conversion is not regarded as transfer and it is not taxable. So that cannot be taxed. This is a gray area in our act and can be said it's a loophole that if a company wants to issue equity shares at a very high premium, which they are not allowed as per Rule 11 UA, they can do this by issuing preference shares convertible in nature, and later on they can convert it. To be even safe, if they issue optionally convertible preference shares, that means compulsorily convertible, it may be argued that it is as good as equity as it compulsorily to be converted. But if it is optionally convertible, then in that case, it is not as good as equity, because we don't know after 5 years whether they will convert it into equity or they will not convert it into equity. So this is a gray area wherever they want to bypass this valuation rule. Now, one important question. If a company is issuing shares on 15th of February, then the balance sheet to be used for this valuation will be of 15th February, or the last audited is also acceptable. गौरव सर है क्या बाहर? अरे यार.
Ma'am?
Hello?
Yes, ma'am. Is there any issue, ma'am? Sorry.
Yeah, sir, no, it's fine now. I guess there's some interruption in the internet.
Okay. So the video might have turned off, it seems. Now you are audible, but video is not visible. You can turn on a video, ma'am. If at all it asks you to turn off, you can turn it off. No problem.
Okay, okay, okay.
Now we are
So we are getting a mixed opinion here that last audited balance sheet, date of valuation balance sheet, the last balance sheet, if it is not older than 6 months for sale of shares of a private limited company, will be valuation of specific date. So let's answer this question, and it is an extremely important question because there are 2 different rules for 2 different sections. I'll just take you to the place. Even if I say that, okay, the correct answer is that a company has to use the last audited balance sheet also, can use the last audited also if the company is issuing the shares. I repeat, if the company is issuing the shares, then the last audited financial statement can also be used. And the important question is where it is written. In that case, we have to refer another rule, which is rule 11U. So basically there are three rules, 11U, UA, UAA. So now we will check rule 11U, where it is given that the company can use the last audited also. Can you see this rule 11U now? Is the screen visible?
Yes, ma'am, it's visible, ma'am. We are seeing the PDF format actually, Government of India.
Okay. Yes. This is rule 11 UA, and this rule is very important because it has given us the various definitions. So here rule 11 UA says, what is a balance sheet? In relation to any company means, for the purpose of subrule 2 of rule 11 UA, now they have defined that for this particular section, that means 2 of rule 11 UA, the balance sheet of such company, including the notes, etc., as drawn upon the balance sheet date, which has been audited by the auditor of the company appointed under the Act, and where the balance sheet on the valuation date is not drawn upon, the balance sheet including the notes drawn upon as on the date immediately preceding the valuation date, which has been approved and adopted in the annual general meeting of the shareholders of the company. That means for the purpose of 11UA2, 11UA2 basically is related when the company issues the shares. In that case, there's an option. Either you can have the balance sheet of the valuation date, or you can even accept the last audited financial statement. Now here one more thing is important. If the company is having a balance sheet as on the valuation date, then it is also to be audited by the auditor appointed under the Companies Act. They cannot have any other chartered accountant certificate or audited accounts. It has to be the same auditor who will provide us the audited report as on the valuation date. I hope this part is clear. So this is extremely important because there's a difference under this balance sheet type of rules with regard to the second rules given under the Act. Okay, now there's a question that if the valuation is done on 15th of June 22 and the balance sheet of 31st March 20 is not yet audited, in that case, the last audited which is accepted by shareholder is 31st March 21. But there can be a big gap here. If it is a very significant difference and we don't want that valuation to be accepted, then either we can go with a valuation or we have to get the 31st March audited balance sheet of 2022 or on 15th June 2022. As per rule, you can accept 31st March 21 because that is the last audited accepted financial statement. Sir, we will deal with right issue in the coming slides, right issue, bonus, etc. Okay, now let's go back to our presentation. So we have answered that this valuation rule will not apply to preference shares. For preference shares, we have a different rule, which is very gray. And so preference shares is basically a very good instrument for surpassing these rules. Second important thing, when the company is issuing the shares, at that time, the last audited financial statements can also be accepted. And where it is written in rule 11U. So 11U basically defines the definition or gives the definition of the term balance sheet. Now moving ahead to the next part. Before we move on to the 56.2.10, I will just have a quick recap of 56.2.7b so that there's no confusion between these two sections. 56.2.7b that we have seen recently is applicable when the company issues the shares. Under this section, there are two methods of valuation defined. One is the net asset value method and the second is the discounted cash flow method. Third important thing is, under this rule, the last audited balance sheet can also be taken for the purpose of valuation if the balance sheet as on the date of valuation is not available. These three important points you should know about 5627B. And the last and the most important one is, under 5627B, the assets are not required to be revalued. I repeat, when the company is issuing the shares, the assets are not required to be revalued. Compulsorily, you have to take all the assets at its book value. So now let's move on to the second part of this. When the existing shares are traded, the Finance Act 2017 has brought two major amendments, one by inserting 56.210. 56.210 has basically replaced section 7 and 7A of 56.2. This section provides that receipt of money or specified property by any person for inadequate consideration or without consideration from any person shall be subject to tax. Simply, it means that if a shareholder A wants to transfer its shares to shareholder B, and if he does this at a price which is less than the fair market value, then it will come with a taxation. It will be taxed under whose hand and how the calculations will be done, that we will see in the coming slides. The second important section that was introduced through Finance Act 2017 was 50CA. Introduction of section 50CA to provide that where consideration for transfer of shares of a company other than a quoted share is less than the fair market value of such share, the fair market value determined as per rules shall be deemed to be the full value of consideration for computing income under the head capital gains. So basically this section is under capital gains. This section is under other sources. And with these two sections, the transaction is basically double taxed. That means if A is transferring shares to B at a price less than the fair market value, then A, that is the seller, will be taxed under section 50CA, and the buyer will also be taxed under section 56.210. This is very important that this section comes with double taxation. Let's move ahead to see what this rule is all about. Firstly, what's the background of 50CA? Prior to introduction of 50CA, where shares were sold by the assessee for a consideration which is not in conformity with the fair market value of such shares, there was no mechanism available under the Act to substitute the full value of consideration as disclosed by the assessee by any other value. For the purpose of this computation of capital gain, Section 50C dealt with transfer of capital asset, being land or building or both, which is not applicable in case of shares. To plug this loophole, Section 50CA was introduced. So as we already know that Section 50C says that if a land or building is being transferred at a price which is less than the stamp value, then stamp duty value will be considered as the sale consideration. But there was no such provision for transfer of shares. And this Section 50C will not apply to 50CA as it specifically deals with land and building. So here 50CA was required to make this provision applicable to shares as well. Now some important points related to 50CA. It is applicable to all assessees. That means even the non-residents are covered under this. Resident, non-resident, related, unrelated, whosoever is transferring the shares at a price less than the fair market value, 50CA will apply. It will apply to all the shares, equity or preference. Unquoted shares shall be the capital asset. This is extremely important that if the shares are held as stock in trade, then basically capital gain sections cannot apply there. Hence, if the asset is not held as capital asset, 50CA will not apply. Not applicable with respect to gains from transfer of an interest in partnership, trust where the property of such entities consist, directly or indirectly, of immobile property, may cover even some quoted shares based on the definition of quoted share. So 50 CA has given their own definition of quoted shares, which says that for the purpose of this section, I repeat, it is only for the purpose of this section, not for other sources. Quoted shares means the share quoted on any recognized stock exchange with regularity from time to time, provided the quotation of such share is based on current transaction made in the ordinary course of business. So if the shares are not regularly traded on a recognized stock exchange, that will also come under this purview of 50 CA. So this is the important points that we need to know about 50 CA. Where unquoted equity shares are contributed by a partner to a firm, the question will arise whether the provision of section 50 CA would override 45(3) or vice versa. So there is no clarity on this. I'll just explain this point again. If a partner in a partnership firm transfers the shares to its partnership firm, then the value of the consideration would be as per section 45(3) normally. But in that case, there is no clarity. Will 50 CA will override 45(3) or 45(3) will override 50 CA? So if you get stuck in any such situation, you need to check the facts and consider the taxability accordingly. No tolerance provided. Thus, fair market value as per the new formula method will be taken as full value of consideration, even if difference in fair market value and the sale consideration is marginal. 50 basically has given a margin of 10%, but there is absolutely no margin given under 50 CA. Even if there is 1 lakh rupees difference or 1,000 rupees of difference, still this provision will apply. In case of sale or consideration being less than fair market value, the seller will be taxed under section 50 CA on the ground that he has not declared true consideration. On the other hand, the buyer will be taxed under section 56(2)(10) on the ground that he has understated the purchase consideration. So as I've already mentioned, this particular thing comes with double taxation. If the transaction is not taking place at fair market value, then 50 CA will apply to the seller and 56(2)(10) will apply to the buyer. And for the same difference, both of them will be taxed under the respective sections. Now we've taken a small example here. X transfers his unquoted shares purchased at a cost of rupees 8 lakhs to Y at rupees 10 lakhs, whereas the fair market value of the share as determined in the prescribed manner is 50 lakhs. That means 8 lakh rupee shares are being transferred for 10 lakh, which otherwise should have been at 50 lakhs. Then in this situation, the provision of section 50 CA would be attracted in the hands of the seller, whose full consideration for computation of capital gain would be at 50 lakhs. Further, Y, who is the buyer or the purchaser, would be liable to tax under 56(2)(10) on the 40 lakh rupees difference as income from other sources. Hence, the difference of 40 lakhs between the fair market value and the actual consideration will be taxed under 50 CA in the hands of seller and 56(2)(10) in the hands of the buyer. So this is important for this particular section. Now, moving ahead, before introduction of this section, lot of people were using this as a tax planning tool. I personally feel that income tax department took a very long time to understand this tax planning. It's very, very common. I'll just show you with an example how the people used to do the tax planning before 11 UA. Before 11 UA, this was the situation. There's a company ABC Private Limited. And this is the balance sheet of ABC Private Limited as on 31st March 2010. There is share capital of Mr. and Mrs. Sharma, 50 lakhs each, land 1 crore rupees. In the second part, we can see the same company's balance sheet, but it is of 2016. In these two balance sheet, basically what has changed is from Sharma, the shares have been transferred to Mr. and Mrs. Verma. What is the tax planning here? You can just write in brief, what is the benefit we are getting by doing this transaction? You can write it on the chat box. What is the benefit that we are getting by transferring the shares between Sharma and Verma family? So one answer that we are receiving here is that the company has saved the stamp duty value in the registration expense. What else? After 6 years also, there is no change in the valuation. No capital gain. Okay, so all the answers are correct. Basically, it is but obvious that in 6 years, there might have been some appreciation in the value of the land. And by just transferring the shares, the company has transferred the land. This has helped them to save the capital gain on transfer of land. Plus, it has saved the stamp duty also. So if the present value of land in 2016 is, for example, 2 crore rupees, then if the company transfers the land, basically it will come with 1 crore rupees capital gain, and the buyer would be taxed, charged with stamp duty on the 2 crore rupees. So here, by transferring the shares, the company could easily transfer the land, because whosoever is the shareholder, the same person will be the owner of the land. This tax planning was basically taken care by the amendment in Rule 11UA. Logically, what it should take is the valuation of land should be fair value. So now there's an amendment that if a private limited company, or to be specific, a closely held company transfers the shares of a closely held company is being transferred, then the valuation of the shares would be done by considering the fair market value of the investments. I repeat, if the shares of a closely held company is being transferred from one person to another person, then the valuation should be done only after considering the fair value of the assets. But fair value of what assets or which type of assets? I don't know whether this is logical or not, but they have defined that only 4 types of assets should be revalued: immobile property, jewelry, artifacts, and shares of another closely held company. I repeat, as per rule, if the shares of a closely held company is being transferred from one person to another, then the assets, 4 types of assets, if on the asset side, must be taken at its fair value. The assets are immobile property, jewelry, artifacts, and shares of another closely held company. So I'll just show you the next screen here. So if this is the case where the shares are transferred, then instead of land, the company has made investment in another private limited company. Then in order to find the fair value of ABC Private Limited, we have to consider the fair value of XYZ Private Limited. And if XYZ Private Limited has invested into another land, then the land is to be revalued, XYZ is to be revalued, and then ABC is to be revalued. It will come with its own set of difficulties that we will see in the coming slides. Before that, let's have some important court decisions. In Boruka Engineering Limited versus DCIT, in this case, revenue contended that transaction of sale or share was a colorable device and virtually immobile property has been transferred. While rejecting such argument of the High Court observed as follow, the assessee by resorting to such a tax planning has taken advantage of the benefit of the law of the loopholes in the law, which has ensured its benefit. After seeing how this loophole has been exploited within four corners of the law, it is open to the Parliament to amend the law. So in this case, if the company is transferring shares while holding any immobile property, this can be taxed under 50CA in the hands of the seller, but not under 50C. Why? Because 50C is applicable when land and building directly is being sold. If the shares are being sold, which of a company which is holding any land, 50C is not going to govern that transaction. It has to be through 50CA only. So that was the need of 50CA basically. DCIT versus Maya Appliances. In this case, according to revenue, the assessee sold the actual land and building in the guise of sale of shares, and thus the provision of section 50C is applicable. However, the tribunal declined to adopt this argument and held that no question of invoking the provision of section 50C of the Act, as there is no direct transfer of land and building. So in order to save the capital gain, people used to use this method, and 50C couldn't apply here as it is applicable only on direct land and building sale. Now, after introduction of 50CA, this loophole is covered. There's one more here. In this case, the revenue adopted the market value of unquoted equity shares, ignoring the valuation given in Rule 11 UA, as it was based on book value of asset. The tribunal held that AO has to compute the fair market value in accordance with the method prescribed and cannot adopt the market value of the shares. The legislature in its wisdom has also given a formula for computation of fair market value, which cannot be ignored. So these are all the cases before the amendments. Considering all this failure, basically they came with this amendment in Rule 11 UA for valuation of shares in case being transferred amongst the existing shareholders. So please turn off the mic. Okay, thank you. So we have already seen here that even if the company is making an investment in another private limited company, still this section will apply because this is included in the list of assets to be revalued. We'll check the law again. So please turn off all the mics. So the formula in case the company's existing shares are transferred is given on this screen. The formula is exactly same. Earlier we have seen A minus L multiplied by PV divided by PE. In this case, the only difference is your asset is bifurcated into four categories. A, B, C, D are all your assets. Liability remains the same. Absolutely no change in liabilities and PV and PE. Only the asset part is changed. Now, what is A? A means the book value of the assets, except those mentioned in B, C, D. So the assets which are covered in B, C, D are to be revalued, and rest of all the assets are compulsorily required to be taken at book value. B is fair market value of jewelry and artistic work. That means A is all the assets other than B, C, D. B is jewelry and artistic work. C stands for fair market value of shares or securities as determined under this rule. So C basically stands for investment done by a company in another company shares or securities. D stands for stamp duty valuation respect of immobile property. So D is immobile property. B is artistic work. How the valuation to be done? As per the report given by registered valuer. C is the shares and securities. How to be done? As per the same rule. D is immobile property. Their valuation will be as per the stamp duty valuation. And L is liability, which is again the same. So we may not take this discussion again. PV is paid up value per shares and PE is paid up equity of the total equity of the shares. So now here is the difference. All the assets except immobile property, jewelry, artifacts, and the shares and securities of any other company are to be taken at book values. Jewelry and artifacts are to be taken as per the valuation report of registered valuer. Immobile property is to be taken as per the stamp duty value. And the shares and securities are to be taken as per the valuation rule given under this act. So I hope this is clear. The formula
Is there any problem?
What is the problem? No, sir, I guess it's automatically getting muted and unmuted.
Okay,
Anyways, it's audible now?
yes, ma'am, you're audible.
Okay, so there are some on-ground challenges on application of this rule. Firstly, the valuation date. In case of 56(2)(10, that means when the company's existing shares are being transferred, the fair market value is to be determined based on the audited financial statement as on the date of transaction. That means for this particular section, we have not been given any relaxation to take the last audited financials. Closing the financials and audit thereof alongside the transaction, closing date is practically a task impossible to perform. Particularly when share, how share at an instance of a insist the company to get its account audited in the middle of the year when he is transferring the shares. While for determining the fair market value under 56(2)(7)(b, there is categorically mentioned that financials valuation date are upon the last drawn financials may be referred. There is no similar relaxation for this provision. To overcome the hardship, a similar relaxation should also be given here. Next, valuing investment held by the entity, a challenge. The mechanism for determining the fair market value provides for valuing even the investment held by the entity as per the same rule. This requires even the financials of those entities to be drawn and audited. This becomes a real challenge as the investee entity would not be ideally ready to draw and share its financial of any particular date with the investor on demand. It means if there's a company A which has made investment in company B, C, D, and in turn B, C, D has made investment in E, F, G, H, etc. So in order to get the fair value of A, we have to first value all the private limited companies which are under this group. It is practically difficult to get the audited accounts in the middle of the year for all the companies, and the number can even be as big as 100. Company A invested into 10 companies, 10 companies in turn invested into 30 companies, 30 companies in turn invested again into 40 companies. Then it's not possible to revalue all the 100 companies on any odd date to get the fair value of company A. So this is a very, very difficult task to perform. On-ground challenges, cross-holding. There can be a possibility where a company A has invested into B and company B has also invested into A. So there is basically a cross-holding. In this case, the Act has not given any particular approach, but I guess this may be done through a simultaneous equation that we once used to do in our school times in maths. But Act is silent on it. We have to find it our own approach and method. Investment in foreign subsidiary. If a company has made any investment in a foreign subsidiary, then as per the rule, the same is also required to be revalued. So the rule states that the fair market value of shares and securities shall be considered. Hence, for any investment in subsidiaries, the value of such investment will be computed by doing the same fair market value exercise under the rule by using the balance sheet of that subsidiary. However, how should the valuation of such shares be done if such investment is in foreign country? So that is again a task. We cannot expect a foreign subsidiary to close the accounts in the middle of the year and provide an audited accounts. There's no answer to this question. On-ground challenges in implementation of this rule again. Underlying investment valuation, whether pre and post tax. This is a very well thought challenge. If today company A has invested into company B and the fair value, for example, is 100, even if the company A sells the shares of company B for 100, they will not receive 100. They will receive less than 100 because the sale of the shares will come with its own share of taxation. There is no clarification given whether the shares are to be taken as a pre-tax value or the post-tax value. If we take the post-tax value, it comes with double taxation. What it says is another critical aspect here is whether the valuation of the investee company should be considered on pre-tax or post-tax basis. Ideally, the investor is entitled to realize his investment only after suffering a DTT, that is dividend distribution tax, or a capital gain tax. Hence, imputing full value of the investee company may result into double taxation, which is not clarified yet. Now, there was a question on right issue. There was a circular which was issued on 31st of December 2018. The Central Board of Direct Taxes issued the certificate to clarify that provision of section 5627A. That time we had that earlier section of Income Tax Act being anti-abuse provision shall not be applicable in cases of receipt of shares by the specified company or a firm as a result of fresh issues of shares by way of bonus shares, right shares, preference shares, or transaction of similar nature. But, however, on reconsideration, it was observed by the CBDT that the matter relating to the interpretation of the term receives used in section 7A of the Act is pending before judicial forum and stakeholders have sought clarification. On the other hand, on the similar provisions in section 56 of the Act, accordingly, with the idea of issuing a fresh comprehensive circular, the CBDT has withdrawn this circular and till date, they have not issued any further circular or clarification. Basically, this dispute is all about the term receives. If the company is basically issuing the shares or there's a buyback of shares, it results into cancellation of shares. So there is a dispute with this receive word, which was earlier there in 5627A. Now the section is not into existence. So basically it is irrelevant. The explanatory memorandum of Finance Bill 2010 explaining the rationale of introduction of the said section inter alia provided that in order to prevent the practice of transferring unlisted shares at a price much below their fair market value, it is proposed to amend section 56(2) to also include within its ambit transaction undertaking in shares of a company, not being a company in which public are substantially interested, either for inadequate consideration or without consideration, where recipient is firm or a company. Thus, it is amply clear and duly evident from the above legislature intent of introduction of section 5627A was to prevent the practice of transferring of unlisted shares at a price below their fair market value. The expression transfer has altogether different connotation and meaning than the expression issuance. When a company issues the shares, it is not a transfer. It is a fresh instrument that came into picture only at that moment. If the asset was not in existence before its issuance, it cannot be transferred. And as such, provision of such section were meant to be applicable in case of receipt of shares by a company or a firm on subsequent transfer of unlisted shares after their initial issuance by the issuing company. So this is the dispute with regard to the term receipt, because if the asset is not there, it cannot be transferred. If it is being issued right now, it is not in existence and cannot have a transfer effect. This is very important. Allotment of shares to existing shareholders at a less than market value. You can take help of this case law, Sudhir Menon HUF versus Assistant Commissioner of Income Tax. It was held that additional allotment of shares to an existing shareholder of a company at less than fair market value as part of genuine business transaction should not be subject to section 5627C of the Indian Income Tax Act, where the allotment is not higher than the proportion of existing shareholding. That means that when a company is issuing right shares to its existing shareholder at a proportionate shareholding, that means their present shareholding proportion, then basically nobody is gaining anything and nobody is losing anything. In that case, they have given relaxation, and you can take the help of this case law. Nothing has been given in act. It is just this case law which gives you basically some relief that if existing shares are being existing shareholders are being allotted some shares proportionately, then the rule may not apply. Now this is again a very interesting scene. Now see, this is a batch 20 and Mrs. Sharma again. The asset side, you don't have any land, have any shares of a private limited company. What they have done is, instead of investing into land or into a private limited company, they have made investment of partnership firm. This partnership firm basically in turn has made investment into land. Now a simple question, if the company has made investment into partnership and the partnership has made investment into land, then is there any requirement of revaluing it? Can this be taxed under this rule? Is the voice audible?
Now only audible, ma'am. For past 10 seconds, you're not audible actually. Now you're audible.
Okay.
Your camera is
I
turned
repeat
off
it
actually.
again. Actually, there's some internet issue, so I've turned off the camera to get a better voice.
No problem. No problem.
Okay. So I repeat the question here again. In this second case, the company has made investment into a partnership firm instead of a private limited company. And this partnership firm in turn has made investment into land. Now, if they are selling the shares of this private limited company, is there any requirement of revaluing the land and then the share in partnership firm in order to get the fair value of ABC? Okay, we are getting all the yes here mostly. based on substance to be revalued, yes to be revalued, not to be revalued as per the strict application of rules. We are getting a mixed opinions now. So basically that all the assets other than jewelry, artifacts, and immovable property are to be taken at book value. They have even said that shares in XYZ partnership firm can be taken under the definition of shares and securities. Can we say that investment in partnership firm is a share or a security? Is investment in a partnership firm a share in itself? No, the answer is no. Rajendra sir has given it correct. The shares or our investment in a partnership firm by the standard term used is basically an interest. It is not a share. So as rightly mentioned, that it is the loophole. If we go by the strict definition here, basically if a company has made investment in a partnership firm and in that partnership firm there is a land, then as per rule it is not required to be revalued. This is still a loophole in this provision. But in the last year, I guess there are few amendments under partnership. So if there are tax implication under that provisions, that we need to check. But as per this rule, land is not to be revalued. I hope this part is also okay. The rule is to be followed very strictly. In fact, they have not given us a scope to revalue even the intangible assets. If there are any intangible assets in the asset sides of a company, which may have a very big value, but as per rules, strictly it has to be taken at book value. There is no scope of valuing it. So all the assets other than the ones mentioned in the section specifically must be taken at the book value to avoid any litigations. So here there's a clarification with regard to partnership firm. The term share is not defined in Income Tax Act. Hence, it will be taken from Companies Act, where the share is defined as share in a share capital of the company. Hence, fair value valuation is not applicable with respect to gains from transfer of interest in partnership, where the property of such entities consists directly or indirectly of immovable property. So this is basically a gray area in the rules to say as of now, but as the income tax department is presently working, they will soon cover this gray area as well. So this was all about the presentation part here. I will just quickly recap the second part again. Second part where we dealt with section 50CA and 56.2.10. Now, when this is applicable? 56.2.10 is applicable when any person transfers the shares of a closely held company to any person. So basically it is applicable when the existing shares are transferred from one person to another. Second important point. Second important point is when the existing shares are being transferred, there is a requirement of revaluation of the asset as defined under third provision. The balance sheet is important point. Under this provision, the balance sheet is compulsorily required to be taken at the any relaxation. The last audit states about this was 6 to 10, section 56. Now, any doubts on this particular section or even any condition? So there's a question, what is the value if transferred to a relative? Basically, if that relative gets covered in that definition given under the Act, where the value at which it is transferred is not taxable, then that will not get taxed. Otherwise, valuation has to be done as per this rule only. Hold term, that is normal 2 years basically, because these are unquoted shares. So 2 years we consider for these shares to be termed as long. Any more questions? So basically, someone asked about right shares. Right shares, there's nothing given in the rule as such. But Sudhir Menon case says that if the existing company is, I repeat again, holding period has to be 2 years for the purpose of unquoted equity shares to be termed as long term. Okay, when the company is issuing shares to its existing shareholders at the same proportion as that of their shareholding, then in that case, there's a relaxation from that case law, not from the Act. Okay, valuation of shares in case it is to a relative. If the shares are transferred to a relative, even at a price which is less than the fair market value, and the relative gets covered in that definition of exemption, like between mother, father, etc., then obviously they will get an exemption there. But if the valuation is to be done, the valuation is to be done as per the same rule. There is no different rule for a relative. One more question, just a second.
I'm not able to see the question, ma'am, or else do you want me to read it?
Yes, I unmuted it again. What if the closely held company is having investment in equity shares of a foreign company? Should it be valued as per this rule in case of transfer of existing shares? Yes, even for foreign companies, they have not given any specific rule. They have to follow the same rule for even foreign company, which again, it's very difficult and practically it's very difficult to apply such rules for foreign companies. But presently we don't have an option because every other company has to follow the same rule. Okay, here I guess there's one more logic here, that if I transfer the shares to my relative at a lesser price, and that will not be considered as a transfer. And if that relative transfer it to some stranger, then in that case, what will be the taxation? Basically, in that case, it's like a gift. If I'm transferring the shares to my relative, it will be considered as a gift. So in that case, we need to check that how the provisions will apply, because if it's a gift, the cost to the original holder will be considered. So you're saying here that A is having shares worth 10. He has transferred the same shares to the mother at 10 rupees itself, and mother in turn is transferring the shares at a higher value to an outsider. So is that the case? I repeat, there is a person A who is holding shares worth 10. He transfers those shares to the mother at rupees 10, and mother in turn transfer it to an outsider. Transfer to 100 fair market value. Sir, I'm not able to understand the question. Can you just illustrate it with some example?
Respected sir, Adimulam sir, I've unmuted you. You can unmute also and ask the question, sir. We'll wait for 1 more minute, ma'am, and I hope all the questions were answered. And also,
Okay.
is there any deliberation to be completed, or else we'll...
No, sir, I'm done with my presentation. Yeah, one more question is there. Wanted to reconfirm, if a company is coming up with a further issue, unlisted company, then book value is to be taken for the purpose of issue of new shares. Yes, if the company is issuing the shares, then the company, if following the net asset value method, valuation will be done by taking the book value of the shares. They are not supposed to revalue the shares. Assets. The assets are to be taken at book value in case the company is issuing the shares. Okay, rupees 10 share transfer at 100 fair market value, then sold at 100 fair market to stranger, to relative in the above case. Okay, if rupees 10 is getting transferred at rupees 100 to a relative, then by default the person who's transferring will be taxed at 90 rupees because the transaction is taking at 90. The exemption will come if 10 rupees is transferred at 10 rupees to a relative covered under the definition of 56. There cannot be a notional income taxed there. Because even if we transfer any asset to a relative at a value less than the fair market value, it is not taxed, like my father or mother under the blood relation given under the Act. If options in an unlisted company are vested or sold, will 56 apply? Options here, which options are we talking about? Okay, now here one more question is, what about transfer of securities other than shares like debentures, etc.? So this is a good question. I would like audience to also think on this, that if the company is transferring debentures, then is it covered under any of the rule that we have discussed today? I repeat, if the company is transferring debentures, which is neither equity nor preference, then are the valuation rules applicable to debentures? You can just have a quick answer, yes or no. Okay, one answer we got is no, no, no. Okay, now the answer to this question is yes. The reason being, the second rule, I'll take you to the slide again. The rule where we mention about preference shares, they have not used the term shares alone. They have used the term shares and securities, and securities includes bonds as well as debentures. I'll take to that section again. Just a second. Okay, here on this slide, we have the rules for the shares which are other than equity and preference. So the term used is the fair market value of unquoted shares and securities. Shares here, which is other than equity. So unquoted shares other than equity is basically preference. And this term securities will cover your bonds and your debentures as well. So this is covered under the term securities. So this is also to be valued as per the rules which is applicable to preference shares. Shares purchased in 2009 and sold in August 2022. What is the fair market value? So basically in between, we have to take the valuation as per the changes that took place. I have not checked it how it is applicable to unquoted equity shares, but there was in 2001 we had the new valuation. So this is purchased in 2009 and sold in the fair market value will be taken as per the August 2022 financial statements. As on the date of financial statement, we have to draw, we have to get our financials audited as on the date of transaction, and that will be considered as the fair market value. And whatever the price we have paid in the year 2009, that will be considered as the cost. So if we are selling it in August 2022, you have to get your accounts audited as on the date of transaction. Yeah, I have already shared this presentation with the institute.
Yes,
I hope that will be shared. Yeah.
Yeah, we'll be uploading it in our SIRC website in due course.
Yes.
So, are we done with questions? Huh? Hope that is.
Yes, sir. Mostly, if there's any unanswered, we can.
Yeah, we'll wait for one more minute and then we'll wind up.
Transfer to relative at fair market value and then sell it to stranger, same value, no capital gain. Is it okay? Sir, I guess if we are transferring any shares to even a relative, it comes with a capital gain. If the transaction is not taking place at fair market value, it doesn't come under taxation under other sources. I repeat, if I am transferring a shares to my relative at its fair market value, I will be taxed under capital gain. But if I don't undertake that transaction at its fair market value, and if it is entered with a relative, it will not come with other sources. But capital gain has not given any exemption to my knowledge. If it's between a relative, then the difference between the transaction value and the fair market value will not be taxed. That is the rule for other sources. Okay. Any other questions? Sold unquoted equity shares of a private limited in 2009. Sold two. We have to look at balance sheet and work out fair market value.
I'm sorry, you are.
So, sir, if we are holding any shares which we originally purchased in the year 2009, and now if we are selling it in August 2022, to get the fair market value take place. For 2009, we don't need any financial statement because whatever the price we paid in the year 2009 will be considered as the cost. We are done.
Yes, it seems.
Any more questions here?
No, it seems, ma'am. But the last question that was answered, right, was a little bit blurry actually. The audio
Sorry
went
for
off.
disturbance in between. About to relatives. Okay, I repeat again. When a transaction is taking place, suppose a person is transferring any asset to a relative at a fair market value, that person should be taxed for the difference under capital gain. Capital gain, I think, has not given any exemption for relative transaction. The exemption is under other sources. If the transaction between a relative is not taking place at fair market value, then the same is not taxed at other sources, not under capital gains. $50C is for land and building, not for shares. $50CA is for shares. And sir, 50CA is applicable in case the transaction is not taking place at fair market value. If the transaction is taking place at fair market value, then it will be taxed normally. There is no role of 50CA there. Then normally when we charge the gain, we will do it as per the normal provision. If the transaction between a person and a relative is taking place at the fair market value, there is no question of substituting that value with any other value. But if it is not taking place at fair market value, then probably it may come with a tax implication under 50CA, because 50CA has not given exemption to relative. Section 56 has given exemption to relative, not 50CA. Okay.
It seems you're done with questions, ma'am. We are getting complimentary messages.
Yes,
So,
yes.
thank you so much for your excellent session, ma'am, and also taking up all the question and making the session interactive. On behalf of SIRC chairman, secretary, and office bearers in the absence, we thank you so much for your time spent here. We look forward to have you in a physical session in SIRC anytime soon later.
Yes.
Thank you so much, ma'am.
Yeah, thank you so much, and extremely sorry for the disturbance on the technical front. And thank you so much for sparing your time and investing. I hope I could do justice with the time of your attendees.
Sure.
Any doubts, you can anytime reach me. My contact details are on the presentation, and presentation is with SIRC.
Yes, we'll share it to them along with the recording in a due course time. Thank you so much.
Yes. Thanks a lot.